Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to see you, Jeff.
Well, a tremendous amount of additional volatility in the wake of the G7 meetings over the weekend. Is a trade tariff resolution between the U.S. and China nearing, Bob?
I don't think we're going to get a trade deal, but I think we could see another tariff truce, especially with some of the positive rhetoric we've gotten over the last day or so.
No, that's a great point. We're also going into the month of September, the last month of the quarter. A lot going on in September, correct?
Yeah, we're starting to get a lot more negative commentary on next quarter's earnings. This quarter's earnings wasn't as bad, so we'll see how that plays out in the market. Market's holding up well.
We will see indeed. Well, it's time to get in the first lightning round, Bob. Are you ready?
Let's do it.
Crude oil. Well, crude oil has been a really interesting trade, kind of stuck in that range in the 50s. It seems tethered to the $55 level, Bob.
Yeah, we're seeing some economic weakness globally, which could affect the demand picture. But we typically see a little bit of a spike in price, a spike in demand off of the end of the summer driving season.
No, that's a great point. So what type of trade example would you approach into the WTI crude oil patch?
What I want to look at is selling the September week 1 52.50 put spread in crude oil. So the selling of this put spread allows an investor to collect about $240. This week 1 put spread expires Friday, September 6th, takes in the Labor Day holiday.
This makes a lot of sense. You have seasonality, you're inside of the range. So I think the October futures on the underlying future contract was trading around 54.36, and the at-the-money volatility, where was that, Bob?
It was about 31.87. Again, still a little elevated, but not extremely exaggerated.
Great stuff. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
I'm ready.
End of quarter. Well, we talked about September, the month of September. What does your forecast look like for the month of September?
Well, I think a little bit less volatility going into new trade talks. And again, I think people are going to start talking very heavily about the next earnings season, whether it's going to be unchanged or negative in terms of earnings growth.
Well, I want to talk in a more optimistic tone. I actually want to be a buyer of the week 1, expiring September 6th, 29.50, 3,000 call spread in the E-mini S&P 500. That's going to expire next Friday, and this is going to cost investors about $330. But this is in the event we do see markets recover, forget about all the rhetoric, maybe we get closer or we inch closer to a resolution of the trade tariff conversations, but this is upside volatility not a lot of people are expecting.
Yeah, so I'm looking at the S&P futures at about 28.8750 when we talked about this without the money volatility, about 17.57. Again, not exaggerated, but still a little elevated. But I'm looking at the market a little bit differently.
Well, Bob, I noticed that you raised your eyebrow when I was talking about buying this upside call spread. What type of trade example would you approach the current E-mini S&P 500 with?
Well, again, the market's moved quite a bit, but I think that's going to continue. I think you're playing an upside surprise well, but I want to look at selling the S&P right around where we're at now. But the stop is pretty wide, 65 handles away. So if you do that in the ES, you're talking about $3,250 of risk. But if you do it in the micro E-mini futures, only $325 of risk per contract. So I like doing that better.
So interesting. Your trade example, you want to be a seller here in the micro E-mini S&P 500, kind of right here at this level we're trading. At the same time, a week and a half out, I'm looking for some type of positive news. So there you go, folks. You have one for each side of the fence.
Yeah, we can both be right on this, again, because my stop's pretty wide, which is why I'm going with the micros.
That is absolutely true. Well, Bob, thanks for coming on Striking Options, and please tune in every week as we will continue to strike options.